What if you could unlock the potential of your portfolio with ETFs that most investors overlook? In today's video, we're diving into 5 powerful ETFs that offer incredible growth opportunities while keeping your risk in check. These aren't the usual suspects like VOO or SCHD. Instead, they're hidden gems that have the potential to outperform, depending on your investment strategy and long-term goals. I've broken them down into 3 key categories: broad market, dividend, and growth ETFs. Each of these ETFs brings something unique to the table, from steady returns and dividends to high-growth opportunities in cutting-edge sectors. By the end of this video, you'll know exactly why these funds deserve a place in your portfolio and how they can help you build wealth over time. So, if you're ready to explore the ETFs that could supercharge your investments. But before we get started, make sure to hit that like button, subscribe for more insights like this, and drop a comment below with your thoughts. Let's start with a powerful ETF that gives you broad market exposure without breaking the bank. SPLG, the SPDR Portfolio, S&P 500 ETF. SPLG might not have the same name recognition as Vanguard's VOO, but it offers the same exposure to the S&P 500 index at an even lower cost. Tracking 506 of the largest companies in the U.S., SPLG includes household names like Apple, Microsoft, and Amazon, with its top 10 holdings making up 34.08% of the fund. This ETF is an excellent way to invest in some of the most valuable companies in the world while enjoying its ultra-low expense ratio of just 0.02%, one of the lowest you'll find in the ETF space. At a market price of only $66 per share, SPLG is accessible for all types of investors, even if your brokerage doesn't offer fractional shares. Despite its affordability, SPLG's performance is impressive. So far in 2024, it has delivered a year-to-date return of 20.13%, with an incredible 33.71% return over the past year. Looking at the longer term, SPLG has gained 93.20% over the last 5 years, proving its potential as a core holding in any portfolio. What sets SPLG apart is its diverse sector exposure. Leading the way is technology at 32.33%, driven by growth from giants like Apple, Microsoft, and NVIDIA. Beyond tech, SPLG covers key industries such as financial services, 12.87%, and healthcare, 12.20%, providing a balance between high growth and defensive sectors. Other important sectors include consumer cyclical, industrials, and communication services, ensuring well-rounded diversification across the economy. With net assets totaling $46.39 billion and a dividend yield of 1.29%, SPLG isn't just about growth, it offers consistent income as well. For long-term investors, this combination of high returns, low cost, and solid dividend payouts makes SPLG a standout choice. Whether you're looking for growth, income, or a core investment to build your portfolio around, SPLG offers it all, without the hefty price tag. Now, let's move on to VUG, the Vanguard Growth ETF, which offers a unique mix of broad market exposure and high growth potential. VUG tracks a diversified index of large U.S. growth stocks and is particularly appealing for investors looking to capture the momentum of some of the biggest names in technology. With 190 holdings in total, this ETF is heavily concentrated in top-performing sectors like technology, which makes up 50.84% of the fund, followed by communication services at 13.87% and consumer cyclical at 12.18%. These sectors give VUG a strong growth profile, driven by companies at the forefront of innovation and digital transformation. In terms of performance, VUG is no slouch. So far this year, it's posted a year-to-date return of 24%, and over the past year, it's soared by 38%. If we look at the past 5 years, VUG has delivered a massive 128% return, making it a powerhouse in the growth ETF space. With total net assets of $139 billion, this ETF is one of the largest and most widely held in its category, and it's easy to see why investors flock to it. At a market price of $379 per share, VUG isn't the cheapest option out there, but it offers incredible value for those looking to invest in companies with high growth potential. Its expense ratio of 0.04% is also extremely low for a growth ETF, ensuring that more of your returns stay in your pocket over the long term. On top of that, VUG offers a dividend yield of 0.52%, paying out $1.96 per share over the past year. So while its focus is on growth, you still get some income along the way. The top 10 holdings of VUG make up 57.84% of the fund's total assets, and they read like a who's who of the most valuable companies in the world. Microsoft leads the way with a 12.54% weight, followed by Apple at 10.82%, Nvidia at 8.87%, and Amazon at 7.07%. Other major players like Alphabet, Meta, and Tesla round out the top holdings, with Eli Lilly and Company adding some healthcare diversification. This concentrated exposure to high-growth companies gives VUG a strong edge in delivering long-term returns. VUG's sector diversification and focus on large-cap growth make it an ideal choice for investors seeking a balance of innovation, stability, and long-term gains. If you're looking for a way to tap into the explosive growth of the tech sector while still benefiting from diversification across other industries, VUG is a solid option to consider. Let's dive into FDVV, the Fidelity High Dividend ETF. This fund offers a great blend of income and growth, making it an appealing choice for investors seeking consistent dividend payouts along with solid returns. With $3.46 billion in net assets, FDVV provides exposure to 109 high-quality companies, spanning a wide range of sectors. Its dividend yield of 2.38% is particularly attractive for income-focused investors, and it's backed by a strong annual dividend payout that adds up over time. One of FDVV's key strengths is its sector diversification. Technology leads the pack, making up 25% of the portfolio, with major players like Apple, Nvidia, and Microsoft representing the top holdings. These tech giants have been instrumental in driving FDVV's impressive performance. But what makes this ETF stand out is its exposure beyond just tech. Industrials come in second at 15.8%, followed by more defensive sectors like consumer defensive, 11.64%, and utilities, 10.60%. This mix of growth and defensive sectors helps balance out volatility, especially in uncertain markets. In terms of performance, FDVV has delivered impressive results. So far in 2024, it's up 19% year-to-date, with a remarkable 33% return over the past year. If you look further back, the fund has gained 68% over the last 5 years. These returns showcase the power of dividend-paying stocks, especially when combined with a diversified, sector-spanning approach. Despite its strong performance, FDVV remains relatively affordable with a market price of $50 and an expense ratio of just 0.15%. This low-cost structure helps keep more of your investment working for you over the long term, which is crucial when compounding dividends and returns. It's this combination of low costs, solid dividends, and strong sector diversification that makes FDVV a great addition to any dividend-focused portfolio. In terms of top holdings, FDVV is anchored by household names like Apple, 5.8%, Nvidia, 5.67%, and Microsoft, 5.38%, all of which are known for their strong growth and reliable dividend payouts. Additionally, companies like Procter & Gamble, ExxonMobil, and Philip Morris International provide stability through consistent cash flows and robust market positions. So, if you're looking for an ETF that delivers both income and long-term capital appreciation, FDVV is definitely worth considering. With its diverse sector exposure and a focus on high-quality dividend-paying stocks, it offers the potential for both growth and stability, making it a solid pick for any portfolio focused on building wealth through dividends. Next up, we have DGRO, the iShares Core Dividend Growth ETF. This ETF is designed for investors seeking not just dividend income, but dividend growth over time. With $30 billion in total net assets, DGRO has become a popular choice for those who want to strike a balance between consistent payouts and the potential for future growth. Its dividend yield of 2.58% is attractive for income seekers, and the fund focuses on companies with a history of increasing their dividends, offering a compelling long-term growth opportunity. One of the highlights of DGRO is its low expense ratio of just 0.08%, which makes it a cost-effective way to invest in high-quality, dividend-paying stocks. That means you're keeping more of your returns over time, which can make a huge difference when those dividends are reinvested. Speaking of returns, DGRO has performed well in recent years, with a 15% year-to-date return and a 27% return over the past year. Looking at the longer term, the ETF has gained 61% over the last 5 years, showing its potential for both growth and stability. DGRO's 414 holdings span a wide range of sectors, giving investors broad exposure to different areas of the market. The largest sector in DGRO's portfolio is financial services at 18.22%, with major names like JP Morgan Chase & Commerce leading the charge. Healthcare, 18.00%, and technology, 17.23%, are also heavily represented, providing exposure to industries that are not only essential but also growing rapidly. This diversification is crucial in managing risk and smoothing out returns during market volatility. DGRO's top holdings read like a who's who of high-quality dividend-paying companies. JP Morgan Chase takes the top spot with a 3.12% weight, followed closely by Johnson & Johnson at 3.0% and ExxonMobil at 2.87%. Other notable names include Apple, Microsoft, and AbbVie, all of which are known for their strong dividend track records and leadership in their respective sectors. These companies offer not only reliability but also the potential for growth, making DGRO a powerful tool for long-term wealth building. DGRO is also strategically diversified across more defensive sectors like consumer defensive, 10.78%, and utilities, 7.08%, which can help cushion your portfolio during market downturns. Meanwhile, sectors like industrials, 11.04%, and energy, 7.33%, provide exposure to more cyclical industries, offering growth opportunities as the economy fluctuates. This blend of growth and stability makes DGRO a well-rounded option for dividend-focused investors. With a market price of $62, DGRO is accessible for most investors, and its focus on companies with strong dividend growth potential makes it a great option for those looking to reinvest dividends for compounding gains. Over time, this reinvestment strategy can significantly boost your returns, helping you build a portfolio that grows alongside the dividends you receive. Now, let's talk about XLK, the Technology Select Sector SPDR Fund. This ETF is a powerhouse for investors seeking exposure to the booming tech sector, making it one of the most exciting growth ETFs on the market. With $69 billion in total net assets, XLK is a massive player in the world of tech-focused funds, and for good reason. It's packed with some of the biggest names driving innovation and market growth. In terms of performance, XLK has been delivering some jaw-dropping returns. So far in 2024, it's up 18% year-to-date, and over the past year, it has posted a 35% return. But the real magic happens when you zoom out. Over the last 5 years, XLK has delivered a whopping 176% return. This explosive growth has been fueled by its top holdings, which include tech giants like Microsoft, 21.28%, NVIDIA, 20.16%, and Apple, 5.01%. These companies are at the forefront of key tech trends, from artificial intelligence to cloud computing, making XLK a perfect fit for investors looking to capitalize on these high-growth areas. Although XLK is primarily focused on growth, it does offer a modest dividend yield of 0.70%, with $1.56 per share paid out over the past year. While the dividend isn't the main attraction here, it's still a nice bonus for investors looking to collect some income while riding the wave of tech innovation. One of XLK's biggest advantages is its concentration in top-tier tech companies. In addition to Microsoft and NVIDIA, Broadcom, 4.36%, Adobe, 2.70%, and Salesforce, 2.57%, also rank among its top holdings. These firms are leading advancements in everything from semiconductors to software, making XLK a key player in capturing tech-driven growth across various industries. What sets XLK apart is its focus on companies that are not only delivering today but are also positioned to lead tomorrow's technological breakthroughs. As we've seen, AI and semiconductor growth have been major drivers of performance, and XLK is well positioned to benefit from these trends going forward. With 71 holdings spread across the tech landscape, this ETF gives you exposure to a diverse array of companies that are dominating the market and pushing the boundaries of innovation. Whether it's cloud computing, AI, or software solutions, XLK is at the heart of the sectors fueling the digital revolution. To wrap things up, these 5 ETFs, ranging from broad market exposure to dividend powerhouses and high-growth tech giants, are some of the best tools you can use to build wealth over the long term. Whether you're looking for steady income, strong growth, or a balance of both, these funds offer something for every type of investor. The key is to find the right mix that suits your financial goals and risk tolerance. If you're serious about building wealth through smart ETF choices, now is the time to start. Make sure to check out my other video on how to build a $100,000 ETF portfolio for even more insights. And don't forget to like, comment, and subscribe to stay updated on the latest investment tips. Let me know in the comments which ETF you're most excited about, and let's keep this conversation going.